So last week we discussed how I trade ahead of the crowd when it comes to stocks that are reporting earnings. Had a question. Is it possible to fade the crowd right before earnings? And if so, how? Well, this week I'm going to discuss just that with a safe way to sell what they're buying, regardless of market direction. Hey folks, Tom Gentile. Suppose you believe the latest fad or meme stock is about to cool off, and you want to take advantage of the drop in option premium due to earnings, but you don't want to sell just a call or just a put due to margin cost. How can we safely sell option premium with high probability, regardless of market direction, and do it with significantly less cost and risk than selling naked options? Well, we do that, folks, with something called an iron condor. An iron condor is a delta neutral position that involves four option strikes. So think of it as two different credit spreads with a bullish put spread that's below the market and a bearish call spread that's above the market designed to capture option premium. Take a look at this risk graph right here. So this is a risk graph. It could be anything. The left-hand side could be stock price, but the right-hand side is the actual condor itself, right? So if we're looking at this, we know the risk is going to be above the call strike in case the market takes off wildly to the upside, or it could be below the put strike in case the market drops really hard. Where you make your money on an iron condor is where the market sits in between these sell strikes. That's where the profits are made. So let me give you an example. Let's say it's mid-June, and we expect the broad market to stay range-bound through July 4th. One way we could take advantage of that is by selling these condors that are out of the money. And let's say we pick a date like July 4th. We're going to look at an expiration date near July 4th. With the S&P trading around 440, let's look at what happens if you sell the 442 calls and the 438 puts on their own. This is called a naked strangle. And you can bring in credit for this. In fact, the credit shows at $565. But you'll also notice that the maximum risk is unlimited. Plus, there's a downside break even and an upside break even we got to think about as well, right? These are options that expire. When I looked at these, they were expiring in just 2 weeks. Now, again, some points we want to make. Maximum risk, unlimited below 423.35 or above 447.65. Maximum reward sits between 438 and 442, and that's at expiration, and that you get to keep what you brought in. So what's the statistical probability of break even or better? Well, it's not that good, right? Even if you were to accept this, the cost of putting this trade on is going to be around $100,000 with your broker per spread. Now, do you really want to tie up $100,000 just to make $565? Let's look at a condor. So I want to change the legs around a little bit. We're going to make this a four-legged trade that still has the break evens around 432 and 447. So on the screen, you'll see what I put together. As a comparison, this is as close as I can find. By selling the SPY 446 calls and 433 puts, that's the ones that I put green in the middle. And then we protect them by buying the 448 calls and the 431 puts. Those are in red. We've created an iron condor. Now, the wings that we purchase, that's the red lines. They protect us in the event that the market swings wildly up or wildly down. Also limits our risk. And we still have reward if the market remains range bound. So let me put the details up there. The maximum risk is $120. Now that's going to be had if we go above 446.80 or we go below 432.20 at expiration. The maximum profit is what we brought in. That's $80. That we keep between 433 and 446 by expiration. The statistical probability of break even or better is around 52%. So the pros, well, we can calculate max risk and max reward as well as probability, and it doesn't cost $100,000, right? That looks good. The problem is that 52% probability isn't that great. And if it stays like that, the strategy just falls apart over time. If only there were a way to do this on stocks and do it with less than a week to expiration with a high historical probability of profit. Well, guess what, folks? There is. And it involves trading stocks around earnings. So in this strategy, what I want to look at doing is putting the condor on right before earnings and then taking it off right after earnings. So let's take a look at this chart. This is IBM. Now, IBM has been known for going pretty much nowhere after earnings. So we could look at selling condors right before earnings and then buying them back to close after earnings. This shows the last 4 quarters. If you were to buy a condor around IBM just before earnings and then exit it after earnings. So sell the condor before earnings, buy it back after earnings. And in 3 of the last 4 quarters, this has actually worked. All right. So again, what we're doing is confirming that IBM has a pattern for doing not that much around its earnings cycle. So you can see in the last 4 quarters, selling these IBM out of the money condors just before earnings report, buying them back, you resulted in 3 winners and 1 loser. Now, take a look at what happened last week. So earnings for IBM were scheduled on July 19th after the close. With some quick work, we were able to see an iron condor you could trade right before the markets, capturing the biggest premiums of the week just before that earnings report. Here's what we came up with. As you can see, you can bring a credit in of $31 per condor if you were looking at buying, and these are all July 21st expirations, buying the 142 call, selling the 141 call, selling the 129 put, and buying the 128 put. Those were all done for around $31 credit. That gave us a maximum risk of $69. So yeah, the risk is about a little more than twice the reward. So when I look at that, it doesn't sound like a fair deal till you see the probability. The statistical probability for this particular trade, because you're creating such a wide condor, is over 90%. And plus, we checked out the math. It worked in the last 3 of the last 4 earnings reports. So the plan is to enter this just before the earnings report and exit the following day. Now, if you'd have done that last week, this is what ended up happening. The following day, you were able to capture 27 of the entire $31. So being able to get in the middle of that spread between the bid and the offer, you're seeing a profit of 90% of the actual maximum credit received, and that was within 24 hours. So if you like this strategy, let me show you some stocks that are on my watch list for this week. Humana is on that list. Colgate, Square, DoorDash, and Amgen all have earnings coming up around the end of July or the beginning of August. And here's the other thing. All of these have gone 4 for 4 with this strategy over the last year as well. Now, why did I blur out the exact trades, the risks, the profits, etc.? I'm not hiding this information because it's a secret. I'm hiding it because I gathered this data and we still have several days before we get to earnings. So that means the stocks could move around, the option prices could move around, and it's best for you to take a look at these stocks and look at condors around these stocks right before the earnings event. Again, what do I like to do? I like to sell these right before earnings event. I like to buy them the following day right after the earnings were announced. In summary, this is a great way to trade delta neutral when going through an earnings report if you want to trade opposite of the herd. There will be losses, just like any strategy, but this one statistically has held up and consistently as well over time. Let me know your thoughts on the iron condor, and I'll see you next week.